Okay, so this is Lecture 13, The Perils of Policymaking, Part 3. We're going to pick up with deficit spending and the national debt. So, as we've seen in the previous section, the federal government has been spending a lot of money lately in the hopes of reinvigorating our national economy. Now, this begs the obvious question: where's all that money coming from? For the most part, the answer is through deficit spending financed by borrowing. Which begs the question then, how does the government borrow money? For the most part, the government borrows money through the sale of government bonds, also called U.S. Treasury securities. These bonds or securities are basically IOUs from the federal government. And they're pieces of paper that an investor can purchase from the Treasury Department, giving that investor the right to collect the total value of that bond plus interest after a designated period of time. This is how the government borrows most of the money that it borrows. It borrows it by selling these bonds, thereby going into debt to the bondholders. In recent years, the Treasury Department has issued an unprecedented amount of these securities to help the government pay its expenses. So that the national debt today is more than twice as large as it was at the beginning of the Great Recession in 2007. In 2007, right at the start of the Great Recession, it was around $9 trillion. Today, and I'm going to show you a website here. This website is usdebtclock.org, which gives an estimate of the total U.S. national debt and all of its varieties. Now, it lists all different types of debt here, but the key figure that you should pay attention to is right up here at the top left, the U.S. national debt, which usdebtclock.org estimates, and it is an estimate, right, because they don't have second-by-second totals, but based on current rates of spending, they estimate that the total U.S. national debt right now is around $19.9 trillion. You could round it up to $20 trillion. So the total national debt has more than doubled since the start of the Great Recession. It's gone up by $11 trillion. So, is such a rate of deficit spending sustainable? Nobody knows for sure, but the common sense answer would appear to be no. Really, it's sustainable as long as people are willing to keep on loaning us money. And that in turn depends on the belief on the part of private investors and foreign governments and other parties buying U.S. debt, the belief that the U.S. government is a good risk, the belief that we are able to pay off the debts that we incur. And as long as people continue to believe that, they'll continue loaning us money. If they stop believing that, well, then they won't. And then we're in a world of trouble, because a huge portion of our federal budget is financed by deficit spending. And that belief that the U.S. government is a good risk, that belief erodes the further and further we go into debt, which I know is a cheery thought. By the way, I wanted to show you this. I wanted to mention this picture. This is a U.S. Series EE savings bond. This is probably one of the most common types of bonds that the U.S. Government issues. It's a bond bought by ordinary people for personal savings or as gifts for high school or college graduation. I received one of these Series EE savings bonds from my grandmother, who gave it to me as a gift for my high school graduation 19 years ago in 1998, which gives you an idea of about how old I am. Don't rub it in, though. So we've covered fiscal policy, which is basically how much the government spends and what it spends its money on. The second major tool that the government has at its disposal to regulate economic cycles is called monetary policy. In essence, monetary policy aims at accomplishing the same basic goal as fiscal policy, which is to manage the economy so as to smooth out the boom and the bust cycles. But the tool used is entirely different. Monetary policy involves regulating the amount of currency that is in circulation. And they do that by regulating lending policies by banks. Now, in the United States, the institution primarily responsible for regulating the banking industry and its lending policies is the Federal Reserve. The Federal Reserve is basically, if I had to sum up its job in one sentence, I'd say the Federal Reserve is the banker's bank. Its main functions include transferring money from one bank to another, holding other banks' money, and also, and this is critical, loaning banks money when they need an infusion of capital. So basically, the Federal Reserve is the banker's bank in the sense that it is the bank that your bank goes to when they need to borrow money. And because of its role as the banker's bank, the Federal Reserve also acts as a supervisor to the banking industry. And because the Federal Reserve loans money to other banks, the interest rates that the Federal Reserve charges affect the interest rates that other banks charge you, their customers, when you or I go to the banks looking for money. So if the Federal Reserve substantially raises interest rates, this generally means that if you want to take out a loan to buy a house or start a new business, you too will have to pay higher interest rates on your loan. So, how does the Federal Reserve use this power? Well, when the economy is in a recession, or when it looks like it's about to be in a recession, it usually responds by cutting interest rates, thereby expanding the supply of credit and making it easier for people and businesses to borrow money. Likewise, when the economy is expanding, that tends to create a lot of inflation, which the Federal Reserve attempts to curb by raising interest rates. So basically, the Federal Reserve exercises what is called countercyclical pressure. Countercyclical pressure on the economy. When the economy looks like it's heating up too much, when it's expanding too rapidly, it's creating a lot of inflation, they know that that presages a downturn, so they'll raise interest rates to cool the economy down. And likewise, when the economy appears to be struggling, they'll give it a quick shot in the arm, a quick infusion of capital by cutting interest rates. They don't always succeed, by the way. The Federal Reserve tried mightily to stave off the Great Recession of 2007 to 2009. They slashed interest rates just as the federal government was adopting all of its various stimulus policies. None of it worked. None of it was enough. All right, let's move on then from monetary policy to tax policy. One of the basic responsibilities of any government is to collect the revenues necessary to pay for the benefits that it provides. These revenues usually come in the form of taxes levied upon the citizens of said government. American citizens pay a diverse array of taxes to their government. We pay estate taxes, capital gains taxes, which are taxes on the profits from investments, land taxes, tariffs, which are taxes on imports, excise taxes, which are taxes on exports, and so on. But about half of all federal revenue comes from income taxes. Income taxes are the main money maker for the federal government. Income taxes are taxes on the incomes of individuals, families, and corporations. In the United States, we have what is called a progressive income tax, meaning that not all of your income is taxed at the same rate, and the total amount of your tax bill is largely dependent on how much you make. So, for example, here's how it works in practice. Sorry, I had to pause the recording there for a second, because I realized the chart that I had up just a second ago was actually out of date. I had the tax records for 2013, not for 2016 up. Okay, so here's how it works in practice. The first small portion of your income is taxed at the lowest possible tax rate. Currently we have 7 tax brackets. It starts out at 10%. So the first tax bracket is 10%. So basically, if you're an individual, a single tax filer, and you are making somewhere between 0 and 92.75, you will pay 10% of your income in income taxes to the federal government. Now that's not taking into account charitable deductions and all the other loopholes, and we'll get into what loopholes are in a bit, all the other loopholes that you can take advantage of to not have to pay that amount. But you pay 10% on that first small portion of your income. Let's say you make $30,000 a year, $30,000 or $35,000 a year. You would still pay 10% on that first $9,200 roughly of your income. But then you would pay a higher tax rate, 15%, on everything between $92,750 and $37,650. All right? And then if you make even more, let's say you make $90,000 a year, we'd say you would still pay 10% on this portion of your income, the first $92,750. You'd pay 15% on everything between roughly $9,200 and $37,000, and then everything over $37,000 you'd pay 25%. Okay, so basically, the more you make, the more you pay, and the more you make, the higher the percentage of your income that you pay to the federal government in taxes. All right, so that's how it works. And incomes, individual incomes in excess of $415,000 are taxed at the highest possible tax rate of 39.6%, roughly 40%. Married or joint filers, if their incomes exceed $46,950, they're taxed at that same rate as well, and so on. Now, obviously, nobody likes paying taxes, right? I'm going to assume those of you listening to this recording, you're nodding your heads. Nobody likes paying taxes unless you're a masochist. And the more you pay, the less you like it. I can tell you that from personal experience. Consequently, individuals and corporations facing relatively high tax rates often attempt to adjust their earning and spending behavior so as to reduce their tax burden. One way they do this is by taking advantage of so-called loopholes built into the tax code. Loopholes are special exemptions and exceptions that Congress has written into the tax code over the years to encourage or discourage certain types of behavior. That's the definition of a loophole. Now, one obvious example of a loophole, although many people don't consider it as such, is the exemption for contribution to churches and private charities. As a rule, if you give money to a religious organization or a federally recognized private charity, you can write off that amount from your taxable income, meaning that the government cannot tax you on the amount of money that you gave. Most people support this type of loophole because it incentivizes behavior, i.e. charitable giving, that is widely considered to be positive or towards the good of society. But there are other loopholes that enjoy far less support. For example, there is something called the tax on carried interest. In addition to their regular compensation, i.e. their paychecks, the senior partners and senior managers in many corporations are paid a percentage of their company's annual profits. So basically their income goes up if their company is profitable, goes down if their company is not as profitable. Which seems fair, except that this carried interest right now it's taxed as capital gains rather than as ordinary income. And the current capital gains tax rate is 20%, not 39.6%. So if you're a corporate executive, say, for ExxonMobil, which is the largest oil company in the world, and you earn $20 million, the bulk of it coming in carried interest, you'd be taxed at 20%, not at 39.6%. So that is a loophole that enjoys less support amongst the public. There is also, believe it or not, a corporate jet loophole. Owners of corporate jets can deduct the cost of owning and operating that jet as a business expense, so that they're not taxed on that portion of their income. There's an outsourcing loophole. The current tax code allows corporations to deduct expenses if they move a factory or office facility from one place or another. Many companies have claimed this exemption when outsourcing their jobs not from, say, Indiana to Illinois, but from Indiana to India. Now, some of these loopholes are unintentional. They result from ambiguities or gaps in the tax code that Congress did not intend to create. But a large number of these loopholes have been written into the tax code precisely because the people benefiting from them have the money and resources to lobby lawmakers to give them benefits. Now, that brings us then to the difference between progressive and regressive taxation. As a rule, the different types of taxes that we pay fall into one of two categories: progressive and regressive. Progressive taxes are taxes that increase as the amount of money subject to taxation increases. Another way of saying that is that progressive taxes fall more heavily on the rich than on the poor. The best example of that would be, of course, the income tax. The income tax, as you can see from the tax brackets here, clearly falls more heavily on the rich than on the poor. Regressive taxes are taxes that decrease as the amount of money subject to taxation increases. Another way of saying that is that regressive taxes are those taxes that fall more heavily on the poor, at least relative to their income, than on the rich. An example of regressive taxes would be the Social Security payroll tax. Now, this is the website for the Internal Revenue Service, the IRS, irs.gov. And I'm going to scroll down here to this paragraph, Social Security and Medicare tax for 2017. We don't need to worry about the Medicare part. It says the Social Security tax rate is 6.2% for each employee and employer, unchanged from 2016. The Social Security wage base limit is $127,200. Now, let me explain what that means. The way Social Security works is it is funded by a payroll tax that is deducted from your monthly or your weekly or your biweekly paycheck. Now, when it says the current Social Security tax rate is 6.2%, that means that the Social Security Administration, which runs Social Security, they deduct 6.2% of your income, and they take a matching contribution equal to 6.2% of your income from your employer. So overall, basically every month or every week, however often you get paid, the government is collecting about 12.5% roughly of your income. Half of it coming from you, half of it coming from your employer, that is kicked into the Social Security system as part of your compensation that you never see. So they're collecting about 12.4% of your income in taxes to put in the Social Security Trust Fund, which is the basically the fund that pays for our Social Security benefits. Now, the reason why Social Security is a regressive tax is this. That tax rate, 6.2%, or 12.4% if you include the employee or the employer matching contribution, that only applies to the first $127,000 of your income. Now, how many of you listening at home make more than $127,000 a year? I'm guessing none of you. Probably not. Okay. So what that means is if you do make more than $127,000 a year, every dollar that you make over that is not taxed for Social Security. So if you make, let's say, $1 million in a year, the first $127,000 that would be taxed for Social Security, but the other $873,000 would not be taxed for Social Security. So what that means is that the rich as a whole pay significantly smaller percentage of their income, of their overall income, in Social Security taxes than do the poor. Now, to be fair, the justification for this is that Social Security is a pension program, not, at least officially, supposed to be an entitlement program. It's supposed to be a pension program, not an entitlement program. So what you withdraw from Social Security is supposed to be based on what you paid into it. And Social Security benefits are capped at a certain level, which right now in 2017 it's about $2,700 per month, give or take. So you can't get any more than that. So, the counter argument would be, well, if this is a pension program and you're capping benefits at such a level, it would not be fair to make some people pay hundreds of thousands or millions of dollars in Social Security taxes that they would never recoup from the program, if you consider a pension program, which is at least officially what it's supposed to be. On the other hand, it does mean that the Social Security tax falls more heavily on the poor than on the rich. So it is a regressive tax. Overall, however, I think it would be fair to say that our federal tax code is much more progressive than regressive, in that the share of federal taxes paid by the wealthy is far larger than the share paid by the poor, which in many cases is virtually non-existent after you take into account deductions and exemptions and so on. For example, right now, the top 5% of income taxpayers pay more than the remaining 95% of income taxpayers combined. So that's it for Lecture 13, The Perils of Policymaking, Part 3.